Mahindra & Mahindra Financial Services is the next company on our radar. It's posted a 40% year-on-year growth in disbursable in the month of April, even as they dropped more than 30% over the prior month. The NBFC, meanwhile, saw its lowest collection efficiency in the last 6 months. What are the key growth areas going forward? Will it explore inorganic opportunities? To discuss this, we've got Mr. Vivek Karve, the CFO of Mahindra & Mahindra Financial Services, here with us in the studio. Mr. Karve, morning, and thank you very much for joining in. Rima here. First, can we talk about the big picture? You have plans to double your AUM by FY25. What will be the key driver for that? And you're open to acquisition, so I'm assuming M&A is a critical part of achieving the strategic objective.
So thank you, Rima, and thanks a lot for having me here today. You're right. We have very clearly laid out our plan of doubling our balance sheet with FY22 as the base. And I believe we have done reasonably well towards that journey, because if you look at the AUM of FY23 exit, it has grown about 27% over FY22 exit. So I believe we are on a good wicket here, and the aspiration is big. Doubling the balance sheet in 3 years. And as you rightly said, we are open to inorganic. However, the focus is going to be on organic.
So this doubling is going to be achieved organically and inorganic will be extra?
No, we are talking about the overall balance sheet growth. Primary focus will be organic. And there again, as you know, today 96% of our balance sheet is vehicle. And that focus is not going to go away, because 75% of that balance sheet in vehicle is rural and semi-urban. So that focus is going to be on. What we are saying is, can we, while growing the vehicle portfolio, can we also diversify into adjacencies? And those adjacencies are in the segments of SME, in the segments of leasing, and in the segment of personal finance. So these are going to be the 3 new pivots, I would call them, in addition to the vehicle finance.
When you say personal finance, do you mean to say personal loans?
Personal loans.
Personal loans.
You're right. Not personal finance.
Yeah. So any targets on some of the new areas beyond auto that you're looking to target for FY24, let's say? What's the kind of growth you would want to see from these newer areas?
So if I have to double our balance sheet in 3 years, we are on a treadmill and we'll have to keep running. I would not want to put out any specific target, because that would be unpublished, price-sensitive information. But I think we will want to grow aggressively towards that particular dream. Having said that, what we have also put out in public domain is, can the non-vehicle finance portfolio by end of FY25, can it be at least 15% of the total portfolio? Today it is about 4 to 5%. Can it be at least 15%?
By end of FY25?
FY25, correct.
Okay. And for is it in this part of the book, the non-vehicle finance, is this where you will be happy to look at inorganic opportunities?
As I said earlier, the focus is organic. And we have built an organization now to build this book in an organic manner. So we have the right organization, we have the right leaders, we are building necessary IT systems to run that kind of a larger business. Inorganic is a nice to have. It has to be accretive to both the balance sheet as well as the profitability. So we are not going to go for an organic just for the sake of organic. Inorganic, I mean, sorry.
Okay, got that. Mr. Karve, the other thing you mentioned is SME, right? Can you mention what is the kind of opportunity you see in this segment, and what part of the SME segment would you like to finance?
Sure. So in the SME segment, what we are going to focus on is primarily a few segments that we understand. So it's going to be agri, engineering, auto, food processing. Again, if you look at the SME segment, it's a very, very large segment. About 25 lakh crore is the size of the segment. And there are 3 sub-segments in SME. So there is micro, there is small, and there is medium. So what we are likely to focus more on is the micro part and the small part.
Can you give us some breakup? You've said you're hoping that 15% of your book comes in from non-autos, personal loans, SMEs. Can you provide some more color within that? Will it be equally divided, evenly spread out?
I would say that SME would be a little over-indexed in that share.
And why is that?
Because the opportunity is very large.
So much more.
Very large.
Mr. Karve, tell us what's going to happen. As you look at, I mean, we've discussed the sort of growth path in a lot of detail. What about profitability and spreads? Because, you know, we've started seeing that with some lenders where there is some repricing happening and some pressure is coming through on margins. You had a fantastic sort of, you know, end to the year, sky high margins, if I remember, 7.3 or 7.4% spreads, right? So what is the outlook from here on?
So what we have again laid out in our medium term is to have an aspiration of a net interest margin of 7.5%.
Okay.
Yeah. So we ended the last year at 7.6. So I believe to have a 7.5% is something which is doable. Year on year, quarter on quarter, there could be some dips, some highs. But if you're able to maintain 7.5%, I think we would have done a good job.
But just to expand on that point, how do you expect your cost of funds to move incrementally, say, over the next 2 odd quarters? If we have indeed seen the peak of rates, then at what point, do assets also start getting repriced? Both assets and liabilities, for that matter.
Okay. So if you look at our balance sheet, typically it's an end-to-end 4 or 4.5 year kind of a loan, which would mean that an average tenure of, say, 25 months to 30 months. And we run a very good ALM match, which means that the liabilities and the assets would typically have a very balanced average tenure, which would then mean that about 25 to 30% of the overall asset book would retire and new book will come on books. Same thing would happen so far as the liabilities are concerned. So last year, we would have borrowed at a higher rate. This year, as you rightly said, the rates are softening and we should get some benefit of that, especially at the shorter end of the curve. So that benefit will start showing up on the balance sheet towards the end of the year.
Okay.
So it's a cycle which would typically happen. So last year, for example, while we borrowed at a higher rate as compared to the previous year, it did not show up so much on the weighted average cost of borrowing because of much softer rate borrowings that we had done in previous couple of years.
So short point, you are confident of holding your margins at these record levels, 7.5% odd?
As I said, I don't want to comment specifically what happens in FY24. However, given that we ended up borrowing at a high rate, and while the softening has commenced, it will take its own time to normalize. There could be some pressure on the NIM margins in the current year, but we will make that good through the better asset quality.
Got that.
All right, we're going to wind down on that note. But Mr. Karve, thank you very much for joining us and taking us through that entire outlook on how you see business panning out. Very aggressive targets by M&M Financial there. Like they pointed out, assets under management likely to double. This is what they've set out for FY25. So extremely positive over there. They also want to increase the non-finance book to around 15%. And this will be led both by SME, personal loans, etc. So looking very aggressive over there on M&M Financial. But